Welcome back. We are discussing asset allocation strategies, the outlook on currency and interest rates. In studio with us via video call is Elizabeth Nkukuu. She is the Chief Investment Officer at Cytonn Asset Management and certainly well versed with investments. She's one of the people we've always looked up to in our career in terms of trying to understand and make better investment decisions. Welcome back, Elizabeth. We were discussing asset allocation and you've given us very good highlights in terms of what to think through. I want to go through the remainder of the report, which is now looking at the real estate asset allocations, and maybe you can give us a view of what are you telling your investors to do, what is happening there.
Thank you, Mbite. In terms of the real estate, a lot has been happening. So to start with, real estate remains an asset that you cannot ignore in the sense that it provides long-term inflation it actually beats inflation returns in the long term. So however, that said, there are cycles in the real estate sector. So there are times that the real estate sector will do well, and some sectors will do well at certain times. So the question is, what should we be doing right now? So first of all, what has happened is in Kenya, there has been a significant rally in the real estate prices over time. Then there came a time, then the question was, is there an oversupply of real estate in the market? So again, debatable. But the question for real estate when you're making a decision is what is the location that you are going to invest in, and what is the concept that you're putting in? Because in real estate, you really lose money or get money just before you even break ground, before you go to the ground. So what we have done is done a lot of research, especially in the Nairobi metropolitan area. And when you're talking about maybe something like residential, we have really narrowed it down to two areas that has significant potential in terms of increment. That is the Kiambu area for the middle income, and if you're looking at the high end, Karen remains one of the best investment opportunities. So for us, our investment is largely focused focused in research, and so that's why we are looking at, if you're doing residential, those are the two areas that you think about. When you think about the office spaces, I think it's something that is going to evolve a bit. Most of us might be working 50% from home. So what that means is that our office is then going to be oversupplied, or what does that mean for the office sector? When we started, I think the year or last year, office spaces were there was a lot of office spaces already. So what this then has happened is that there could even be more significant oversupply in that sense. So it really means you really need to look at what kind of offices are you looking at. But when you're talking about something like grade A offices, there's still potential for investors who are looking at there. When you look at mixed-use development, I feel like it's the next new norm. When you think about Yaya Center, I think it has continued to do well. It's really close to residential places. It has a residential place within it. So those are kind of the things that you should be looking at. So look at the location and also the concept that you're coming in with. So real estate will continue to do well in the long term, but in the short term, I feel like there will be challenges.
And are there other alternative investment classes? Because we always just talk about bonds and T-bills, equities, and real estate. Is there an active market for commercial paper, for corporate bonds, especially given the liquidity that the private sector could possibly experience as a consequence of COVID?
In the past, it was more active than it is today, especially on the commercial paper side, and just because of what happened initially. When you think about what happened with Nakumat, really brought down a lot of investors' confidence. The confidence level for those papers actually came down. So what should happen, in my view, is that there needs to be a lot of support from the authorities so that people and private businesses can come to the market and raise money. But at the same time, there needs to be a lot of protection of the investor. So a lot of diligence needs to be done before approvals of the same, because once the investor sentiment confidence is really dented, there is really little that you can do about it. So it's really important for the authorities to come in and protect the investor. But at the same time, when you look at what happens in other global markets, most of the business funding actually comes from the capital markets. as opposed to the banking sector. When you look at for us now, the banking sector contributes to a lot of capital in form of loans. So what needs to happen is like a structural shift and mind shift, then the capital market leading that, so that we can see actually a lot of support for businesses coming to raise money from the market. So yes, there are different ways that can be looked at in terms of funding the businesses, and also, and that will create a lot of opportunities for the capital market.
So then, typically today, are we just saying that your investor can either put money in a money market, such as your money market, or go directly to the equities, or buy an apartment, or buy a government bond? Is there anything else that investors in Kenya can possibly do to get a good return?
I think there's derivatives, but again, it's within the stock market, so nothing much there. There is no active private equity market. So, and if you go offshore again, you have to go through the commingled fund. So in a nutshell, if you want to invest in the securities market, you're kind of boxed in a way.
It's very limited opportunities, and it does take a lot of time maybe to get a return. Perhaps then we can end this session with 2 more questions. I'd like to touch on money market funds and maybe focus on yours, and then we can finish with your expectations on the economy. So now, earlier in the conversation, you've told us that there's a low likelihood of the RBA's proposal coming to see the light of day in as far as deferring interest payments are concerned, which would be tantamount to a default risk. If that's not going to happen, do we then expect to see the money market returns that we have seen, and certainly your fund has been the top in terms of its performance, I think at about 10.4%, if I'm not wrong, from the last number that I saw? What's the expectation for people who are putting money into that fund in terms of returns maybe over the next 12 to 24 months?
By the nature of the money market fund, the returns have relatively been stable, and within on average, the industry average is about 10%. So my expectation is that we will not see significant jumps there, and just simply because of we are investing in government securities, we are investing in bank deposits. I don't see a significant change from where we are, maybe 100 basis points thereabout. Then given the fact that there are not many commercial papers that people can invest in as well, so you are almost like at where you are, almost like a stability zone. So I really expect investors to continue getting that kind of. About the returns that we are declaring as money market funds is that the returns are well above inflation. So you are still getting some sort of a real return, which is good compared to maybe putting that money in a savings account, and you'll get maybe something just par to inflation at best. So money market funds help in one thing: you have liquidity. So when you need your money, you get it. And maybe when you think about and a lot of digitization has happened. So if you think about maybe our money market fund, and I think a couple of others, even when you're shopping, you can actually withdraw your money and pay that, you pay for the goods using that money. So the liquidity is there from the money market, and then you're also getting a return, which is actually positive to inflation. So returns will remain as is, but provides you 2 things: security and better return.
Look on the economy just in general.
If you look at what is happening in the economy, and I think we did a note on it, and just reading from maybe what the IMF is saying and all that, it will be a struggle for this year. Maybe we'll grow by, let's say, even on average about 2%. So when you're growing at 2% and inflation is well above, maybe an average of even 5% at best, what it actually means that in real sense the economy has shrunk. So when you think about it, there will be a lot of challenges this year, but hope as a country we shall take a step back and use this as a base, and almost like prepare for next year. So assuming that there was no 2021 in terms of growth and all that, but what does it mean in the long term? So sort of consolidation. If we are to look at how do we grow the Big Four agenda, and for me I would look at the manufacturing sector. What can we do it local? What can we manufacture locally? That is what will help us going forward. 2021 will be a difficult year. This year will be a difficult year, but next year could maybe form a base for growth.
Absolute final question. I like to visualize me being a millionaire, and I like imagining that perhaps I have 100 million shillings, and then I'm seated with Elizabeth, and Elizabeth has a good track record. Where would you tell me to put my money for at least the next 5 years if I came to the 100 million?
Give me 100 million, or you wanted to invest 100 million. This I would not tell you to go to one particular asset class. Remember that the person who invests in one asset class is the person who thinks that they are correct all the time. So I would look at, how do I invest this? I would take a portion of the bulk of it. In my view, I would actually look at it 50-50. When I have 100 million, what that means is that I can afford to lose some money as I look for more. So put some of it in the risky asset, that is real estate and equities, but also put the balance of it in fixed income, because you also don't want to lose a lot of your money. So government security is a good place to start with.
This conversation with the person who puts all their money in one asset class assumes they're right all the time, and that is never the case. I think if there's nothing else, thank you so much, Elizabeth, for your time. I certainly do hope that we can be able to have another conversation with you later on once COVID tapers down. I wish you and the team at Cytonn all the best. Thank you and good day. Okay, so we have come to the end of this segment, and we were looking at Cytonn Asset Management's report. They publish a report each and every week. The key trends for this week for them were currency and interest rate. This report was looking at the outlook for this, and we had a very extensive conversation with Elizabeth Nkukuu, who's the Chief Investment Officer. A lot of things have been said, but she sees opportunities in equities if you're able to wait it out for maybe 5 years at the very least, because you can make a very good return there. She's also very she's neutral when it comes to the returns from the money market funds, and she's a bit cautious when it comes to the economy. So there's a lot happening, and it's certainly a report that you want to be reading up on and trying to see how you can be able to diversify your assets. That's all from us today at Markets Today. Till we meet again, same time tomorrow. Thanks and good day.